Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing ZIM stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. ZIM is one of the largest shipping companies in the world. It currently operates 150 vessels delivering cargo to and from 90 countries. In addition to containers, it transports vehicles such as regular and EV cars, buses, and trucks. They currently charter 11 car carrier vessels, and they operate in China, Japan, South Korea, and India. They're expanding to Europe, the Mediterranean, and South America. Because it's not easy to transport cars from one country to another. Vessel is really the only way to do it. You could drive the car there, but that seems kind of silly, right? The company is headquartered in Haifa, Israel, and was founded in 1945. They also have a headquarters in Norfolk, Virginia. The ticker trades on the New York Stock Exchange and Deutsche Börse. Let's get started with the model. This is a mid-cap company, $3 billion market cap. They're trading at $24 a share, and they have 120 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their growth is unheard of. 350 million of free cash flow up to 5.8 billion. What is that, like a 15x growth? Unreal. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also amazing as well. 4.6 billion in 2021 and 2022. Revenue is a sales for the company, and that went up 300% from 3.3 billion to 12.5 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that went up from 260 million to 6.4 billion. Their gross margins are above 50%. Back in 2019, they were below 10%. Gross margin is gross profit over revenue. It's how well you convert revenue into gross profit. Below that is their operating expenses, which are really low. Gross profit minus operating expenses gives you your operating income. And look at that, over 6 billion in 2022. Amazing margins. Then below that is the interest they pay in their debt. They paid 148 million in 2022. Other income and expenses are all the gains or losses not part of the company's core operations. Your pre-tax income, taxes, and the bottom line of the income statement is your net income, which is well over 4 billion in 2021 and 2022. It was negative in 2019. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. This company is a cash cow. That's why they've been paying such big dividends, over 6 billion of cash flow in 2022. They don't spend too much on CapEx. They did spend 1 billion in 2021. When they do spend a CapEx, that's usually to acquire vessels. Operating cash flow minus CapEx gives you your free cash flow. And that's how they pay such a big dividend from their free cash flow. They're not really diluting shareholders. They did a little in 2021. And it looks like they're paying down a lot of debt. They paid down 1.5 billion in 2022, 1.2 billion in 2021, and over 300 million in 2019 and 2020. So it's a really lean company. Let's look at the capital structure. 5.9 billion of equity, 4.3 billion of debt. They're 58% equity, 42% debt. And their net debt is 1.1 billion. Net debt is total debt minus cash. So they have over 3 billion of cash on their balance sheet. I gave them the highest whack on Finbox, 15.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 17 billion. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $17 billion. We divide that by 120 million shares, and we get a calculated stock price of 139. They're trading at 24, so they're trading at an 83% discount. It's a really strong buy according to the model. Their revenue forecast for 2025 is 7 billion. For 2024, it's 6.3 billion, and for 2023, it's 6.3 billion. I continue this growth into 2026 and I got 7.8 billion. That's how I got their future revenue estimates, which are a lot lower than what they are currently. And to calculate their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers and I divided by the sum of these 4 revenue numbers. And that comes out to 39%, so I multiplied their future revenue estimates by 39%. That's how I got their future free cash flows. And I usually assume a 2.5% growth for the terminal value, but I gave them a negative 2.5% growth. Even with that and the really high WACC, it still seems extremely undervalued. It's not too common to see, but Simply Wall Street says a stock is really overvalued. Their value is $7. Because it always seems like Simply Wall Street has stocks really undervalued. In this case, it's the opposite, which is really interesting. 5 analysts priced this stock and the average price target is $20, the lowest $15, the highest $27. Another 7 analysts priced this stock and their 1-year price target is $21. So they say the stock is 14% overvalued. This is where the stock has been trading since it IPO'd. So it looks like it IPO'd in January 2021 and there was a huge run up to about $90. Then it came crashing down ever since that point. It did get below $20, but now it's sitting around $24. When you see a red bar, that means the sell orders are higher than the buy orders and the stock comes down. You see all these red bars? And when there's a green bar, that means the buy orders are higher than the sell orders and the stock price goes up. You see all these green bars? The higher the green bar, that means there's a lot more buy orders than sell orders. And when there's a high red bar, that means there's a lot more sell orders than buy orders. When it's a really low bar like right here, that means the buy and sell orders are almost equal. If you compare ZIM's performance to 2 of their competitors, Starbulk, SBLK, and CMRE, ZIM and Starbulk are up about 100% since ZIM IPO'd in the beginning of 2021. And Costmare is up about 15% since ZIM IPO'd. This does not show you your return with your dividend payments. If you bought ZIM at IPO, you're probably up like 200-300%. And as you probably thought, this is a really volatile stock. It has a beta of 2. That means it moves 2 times the market. It's down 64% in the past 52 weeks, while the S&P is down 13%. So if the S&P was up 13%, this stock would probably be up like 40-50% because it's more volatile than the entire market. In the past 52 weeks, the low is 16, the high is 74, and the stock is trading between its 50-day and 200-day moving average. This is a pretty popular stock. 5 to 7 million shares are traded each day. Of the 120 million shares outstanding, 94 million are on float, 34% are held by institutions, and has a really high short percentage. 21% of the shares are shorted. And look at these crazy dividends they pay. $2, $2.50, $17, $2.85, $4.75, $2.95. And the way I calculate the dividend yield is I take the last dividend payment, multiply it by 4, take that number, and divide by the stock price. That's how I got 48%. This 48% assumes they pay a quarterly dividend of $2.95, which they can't afford. It's only 25% of their free cash flow, 31% of their net income. If you put $10,000 into ZIM when they IPO'd in January 2021, you'd be up 250%. You'd have $35,000. Remember earlier we looked and the stock price is up 99% since they IPO'd. The other 150% are those dividends. 44% of the company is held by the general public, 34% by institutions, 21% by private companies, and 1% by insiders. Their biggest shareholders, Court Investments, they own 21% of the company, then BlackRock, Arrow Street, Renaissance Technologies, and Altshuler Shaham. Their employee count has been going up over the years. They currently have 4,800 people on staff. The best way to look at ratios to compare them to companies in the same industry. There are 29 companies in the same industry as ZIM, and if ZIM has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So you can see that the second largest company on this list, this is in terms of market cap, the largest is Kirby at $4 billion. They spend more on CapEx than any company in this list. They have a good debt to equity ratio. For every 70 cents of debt, they have $1 of equity. The lower the better. They pay a really high dividend. Look at these crazy dividend payments, 25%, 25%, 23%. They may generate more free cash flow than the other 28 companies combined. And they have really good price multiples. Look at these ratios, unreal. They generate tons of revenue. They have an amazing ROA and ROE. So to summarize, I have them trading at an 83% discount. And this is not a slam dunk. Even though I say the stock is 83% undervalued, this is just according to the numbers. You can't predict the future. The most important factor for this company are shipping rates. If shipping rates go down a lot, they will lose money and the stock will go down. But if shipping rates stay steady or grow a lot, they're gonna make a ton of money, like they did in 2021 and 2022. Shipping rates tend to be really volatile. It's not like selling a product like Kraft Heinz sells ketchup. They know there's always going to be demand for ketchup, and the price of ketchup isn't going to fluctuate that much. It'll probably move with inflation, maybe a little more, a little less, but it's not going to swing like 200%, 150%, go down 50% like shipping rates do. I rank their free cash flows and revenue 9 out of 10, their ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.